actually has an intrinsic value of nothing. That has a very, very strong correlation historically with the gold price. We potentially have all the big moves in front of us.
Today we are joined by Lord Ashbourne, formerly Charlie Gibson, Director of Content on Mining for Edison Investment Research. Charlie is going to be giving us his in-depth analysis on gold, what affects its price, and where he thinks the price of gold may be going. Welcome to the show, Charlie.
Tom, thank you very much indeed.
Great stuff. Let's dive straight in. So I'm going to ask a fairly broad, big macro question, which is quite simply, why gold?
I think why gold, because it should always be why gold, and the answer should always be gold. And there are several reasons for that. And one is it is probably the most fundamental currency unit that mankind has ever devised. Now, we tend, particularly in this country, not to think about it that way anymore. But nonetheless, when you see governments printing money, when you see inflation, when you see all the things, the sort of the human things, that cause governments to create paper, because paper, and with the greatest respect to all the paper companies in the world, has an intrinsic value of nothing.
Yeah.
And now it has value because we use it as a currency, it has value because we use it in the economy, and because governments use it to collect tax revenues, and from that they can pay for their bonds. So it has value in that sense, but it has no, or close to zero, intrinsic value. And gold, if you like, because it, throughout almost all of human history, has been that, both that medium of exchange and that store of value. It always sits behind currency as a way of valuing what that paper is worth. And so whenever there are times when we're expanding, particularly the paper supply of money, you need to look for gold. People often look at it as an insurance policy, but actually, if you take it since 2002, if you take it since 1967, which was a very good year in lots of respects, because that was the year in which I was born, it has actually outperformed the Dow Jones in capital terms. So not only, I would say, is it an insurance policy, but it's also a very good performer in its own right.
Great stuff. I mean, what are the fundamental, I've read a bit of your report and I've seen kind of some of the things you've laid down of what affects the price of gold, but if you wouldn't mind kind of just breaking them down into their respective parts of what are the fundamental key things that affect the price of gold.
So I talked about the supply of paper money. So if you look at the total US monetary base, that's one of the things. If you look at a subset of that, which is, and the total monetary base I always look at, that is currency that is in circulation and currency that could be in circulation. Yeah. Now you can break that down, so you can also look at the gold price with respect to currency in circulation. They both have incredibly strong correlation coefficients with the gold price in the period of paper money. Inflation, we talked about that. So you can either look at inflation or you can look at the level of the CPI, and again, gold has a very good correlation with that. And I think the thing that everyone's looking at the moment is real interest rates. Yeah. So it's that balance between inflation and interest rates. And when you see people talking about the gold price, the annoying thing, one of the annoying things to me is what they tend to do is they tend to hold one of those steady. Yeah. And they tend to talk about inflation rising, that's good for gold. Well, it is if interest rates are static. But it's not if interest rates. And of course, the two always move, so you're in this permanently dynamic situation. That's why I sort of try and cut it out and say, well, let's look at them both together and let's look at real interest rates instead. But those are the sort of the four big movers that I've been looking at certainly in this report. And can I just say, anyone wants this report, it's free on the Edison website. So if you go there and look for it, and if by any chance you can't find it, send us an email and we will send you a copy of the report.
Yeah, we'll put a link under the video as well. To put it into context in today's inflationary environment. So we still have inflation in the US, it's around that 3.5% mark, and we've got high interest rates. Mm-hmm. So could you kind of put gold in the context of the current market conditions?
Yeah, absolutely. You're showing your age by saying we got high interest rates, but because there was a time when it was a lot higher, and let's talk about that in a minute. I mean, I got some slides. Can I just sort of go to the slides? So I mean, I think the first slide here just shows us the gold price, and I think the key thing is you see that gold is moving in these very, very big cycles. So you've got 1970 to 1980, big bull market, the first real bull market since the link between gold and the dollar was broken by Nixon in August 1971. Yeah. And then we have a bear market, 1980 to 2001, bull market, 2001 to 2012, short bear market. You could look at that as a correction of the bull market. And then certainly since 2019, we've had another leg of that bull market upwards, which has taken us from sort of $1,300 an ounce to close to $2,000 an ounce, and that's where we are. And it's these big cycles I like to focus on rather than these sort of minutiae. You ask me where gold's going tomorrow or next week, I haven't got I won't say I haven't got any idea, but I've got a lot less idea. But it's these big bull markets, because if you get the big picture right, then kind of the noise around the small picture you're not going to worry about so much. So that's just really a bit of background. But vis-a-vis, we were talking about real interest rates, weren't we? If you go on to the next slide, and these are the sort of two crises that I want to compare here. And I think because we've got real interest rates and they become meaningfully positive for the first time, really. For the first time, in all honesty, certainly since 2007 and arguably since 2001. And the analog to that is what happened in the period 1970 to 1980. So I put these two side by side. And what you've got on the bottom axis is months. I mean, really it's years, because I start at month number 1. So month 13 is the end of the first year. And then you've got real interest rates. And what you can see, if you look over to the left-hand side of the chart, the top two lines, the dark grey and the dark green line, those are real interest rates. And so if you're looking back to June 2004 or January 1971, those were all moving in a positive direction. Things were pretty good in those times, but underlying it, there were problems. And in both cases, the US, and I always talk about the US because the gold is priced in dollars, and because gold used to be linked to dollars at 35 to 1 prior to 1971, and so that's the way I think of it. But the US was running these twin deficits, government balance of trade and also government spending, and that was causing interest rates to go up. And the Federal Reserve were reacting completely conventionally. They were putting up nominal interest rates, real interest rates are rising, and what happened is it popped an internal credit bubble in each case. And that was a global financial crisis in 2007, and it was exactly the same thing in the 1970s. So you see there, sort of, you've got a peak, if I can just sort of, for each market there. What you get is then you pop the internal credit bubble, everything starts getting sucked into a debt deflation spiral. It's a nightmare. The Fed cuts interest rates, in fact, real interest rates go negative, and both of these then are designed, they're calibrated so that the nadir of real interest rates is the 50th month, and then you have the recovery period. And two or three things really stand out here. Is first of all, in the 1970s, how much faster the economy recovered, and they were able to achieve zero real interest rates much faster. And we went through, we've effectively been best part of 2 decades now in what I would say is near crisis mode, and real interest rates have not been able to be positive. Now, everyone took it for granted, for example, in the period 1980-2001, that real interest rates would be positive. But we've had 15, 16 years where they've basically been negative for the entire time. Anyway, so in the 1970s, you had a faster recovery to zero real interest rates. And then what you got when they tried to put interest rates positive, you got, first of all, and if you look in that left-hand oval, you see this real volatility in interest rates, in real interest rates. And that is either inflation or interest rates, and they're doing this. And you compare that to what's happening in the oval on the right-hand side over there. And you can see we've just gone into positive, sort of meaningfully positive real interest rates for the first time there. And so that's why I've got that sort of horizontal arrow going back, saying when was the equivalent period in the 1970s? And what you're getting back to is sort of September, October 1979. And I think that's the period when, so what we've got is a period of real volatility. We've also got the apex of the gold price to come, because that is now still before us. And the final thing I think it's worth saying is that the gold market didn't top out until real interest rates made 4%, and they made it on a consistent basis. So I think the gold market is still, the gold price bull market is still intact. Now, we may be in the later stages of it, because let's face it, gold has been going up arguably since 2001 and very definitely since 2019. But actually, we potentially have all the big moves in front of us. And I think I can show that on the next slide, if we could go through there. Now, this is exactly the same data for what I would call the current crisis, 2004 to 2023. And you've got real interest rates on the x-axis, you've got the gold price on, and it just simply plots them against the two. And where we are now is where that arrowed circle is which you can see there. So we've got inflation at 3.7, and we've got real interest rates about 5.25%. Nominal interest rates 5.25%. So we've got 1.5% real interest rates, and then you say, well, what should the gold price be? And if you look at the line, which is the best fit line, that black thing, then you say, well, the gold price should be a lot lower. So then I asked the question, well, what happened in the 1970s? What's the equivalent period? And we'll see that if we go to the next slide. That's the equivalent period. Now, for January 1971 to August 1979, I've chosen August 1979 very deliberately, and again, August 1979 is arrow. You have almost exactly the same sort of correlation.
Yeah.
You've got a long period of time, you've got a decent correlation. It is statistically significant, as what they say is the 5% limit. And then you say, right, what happens next? So I think if we go over to the next slide, what you can see is then what is the relationship between those two lines. So you've got the green squares, which are where we are at the moment, and we've got the circle there where we are actually specifically. Yeah, and so that's the period we've been in, 2004 to 2023. Now the point is, if the gold price rebases in the same time now as it did in the 1970s, what are we looking at? And if it rebases $400 an ounce higher, we're looking at the lower green line. That's the line it'll start to trade around. If it goes for 4 and a bit times higher, then we're looking at the upper grey line. And so when you hear analysts talking about $3,000 an ounce, $4,500 an ounce, that's where they're getting these sort of figures from. But we're looking for this sort of rebasing in a period of volatility. And I think you can see that, you can see hints of that when Federal Reserve members are talking. Now, they obviously don't want to start talking the language of real interest rate volatility, because that becomes a difficult thing to manage.
Yeah.
But you can see they're very focused on where these inflation numbers are going to go, where they think they're going to go. But you can also see the potential for the reality to sort of move away from the expectation quite sharply. And, one of the things, for example, that's, might drive that could be the oil price. We're beginning to see a lot of volatility come into the oil price, and big moves there. And that can make big differences to inflation. So you also have the potential for interest rates to suddenly go up, suddenly possibly to go down suddenly. So you've always slightly got one, which is inflation leading interest rates, and you have the possibility of unexpected moves, and then they get out of counter phase. They move interest rates down, but inflation goes up. That's where I expect the volatility to come from. So I think we're looking at a period now. 1979. It wasn't a particularly comfortable period in human history, but I think you could look at 2003 and say that's not a particularly comfortable period either. I go into some of the political parallels in the report, but in my opinion, they are quite striking. You have global leaders being assassinated. You have immigration problems. In particular, you have the Soviet invasion of Afghanistan. So quite a lot of the same sorts of things were happening then as were happening now, and so that's why I think we might get a very similar, what do they say, history doesn't repeat, but it does rhyme. Yeah. I think we may see a fairly strong rhyme between what happened in 1979 and what's happening in 2023 now.
Yeah, that was going to be one of my questions, actually, which is that, gold is historically seen as a hedge against economic uncertainty, geopolitical kind of instability. We've just, as we know, recently had the Hamas attack in Israel. Does that as we've still got the war going on in Ukraine, does that kind of all add to this picture? As you say, it all draws those parallels between the 1970s. Does it all kind of add to your bullish case for gold? Well,
I think very much so. I mean, if you compare it to, say, the 1990s, when the West was sort of, claiming that we'd had the end to history and that we'd won the Cold War and everyone was coming into this sort of democratic free market consensus, it's clearly a very, very different time compared to that. Yeah. And, as I look back in my lifetime, and obviously you can't remember this, but as I look back because you were a wee stripper lad, but as I look back in my lifetime, it feels similar. I would have said. I know we had the sort of, there was a more polar world during the Cold War in 1979, but we have a pretty polar world now, and Russia is to some extent taking the place of the USSR, and, the parallels between the Russian invasion of Ukraine and the Soviet invasion of Afghanistan, it's virtually impossible to miss those. So, I would have said it feels sort of similar. There's that sense of uncertainty. And also that sense of heightened inflation as well. You know, the inflation was generally higher in the late 1970s than it is now, but nonetheless, you know, we hadn't seen these sorts of levels of inflation. You know, sort of double. I mean, there's not double digits, but we hit double digits in the US, and we haven't seen those, well, you know, for a good generation, if not longer. So I in my opinion, the parallel's definitely there, and I think, you know, emotionally, anecdotally, I'd say it feels like that as well. I mean, I could tell you a story, you know, in terms of what it means for the value of money. Early 1970s, my father left my brother and I. We were young children in the car, because you could do that in those days. And he went off to, you know, do something, and he came back and he said, look at what I got. And he showed us a note. And he showed us a £10 note. And we all oohed and ahed. It was one of the earliest Florence Nightingales. And then he said, right, you stay in the car, I'm going to the bank to change this. And he said, what do you mean? You got this £10 note, this thing in your hand? And he said, no, he said, £10 is much too much for anyone to carry in their pocket at any one time. Right. And that sort of gives you an idea of what can happen to the value of money. Because, you know, come the 1980s, and we were taking £10 notes out of the wall like confetti. Yeah. But it gives you an idea of what can happen to the value of money. And you know, that's sort of one of my memories, and it's possible, you know, the same thing will happen. You know, you would probably do the same thing with a £50 note, wouldn't you? Now, if you had a £50 note, you might take it to your children and say, look, you don't see very many of these, and you know, and then you might go to a bank and you might say, look, can you give me, you know, 2 20s and a 10 or something? And you know, but it's possible that in 10 years time, you know, we might think nothing of having, you know, half a dozen 50-quid notes in our pocket. It just might be the sort of thing we carry around. Sounds funny, doesn't it? But that's, you know, that's what happened to the £10 note. So,
I mean, just for the sake of balance, you've mentioned quite a lot of the similarities between, you know, today's market and the 1970s. What are some of the dissimilarities? What are some of the kind of differences in the way the financial market is at the moment?
Actually, oddly enough, there was actually less volatility in the total US monetary base in the late 1970s compared to now. Obviously, financial markets are more developed. There are more players in the financial markets. You know, in the 1970s, it was very much a rich Western world. It was Europe, it was America, it was Japan, and that was it. And now there are some other big players. In the 1970s, I think, you know, the particular dynamic that you were looking at was you saw the British and the Americans come out of the war. They set their currencies at quite high levels. They pegged them to gold, and then what you had is you had the Japanese and the Germans, and to some extent, and the French, and they had their currencies pegged at much lower levels. They were extremely competitive with their manufacturing industry. We were hoovering up Japanese and German-made goods, but the difference is when you got these sort of, you know, these big moves and these tipping points and you know, these points of inflection, roughly speaking, the way I would say is you knew that the West, that America and Britain and Germany and France and Japan, they were all roughly on the same side, and they were all playing the same game. Now what you know, the rising economic power is China, and it might be India, you know, in years to come, and they're not quite part of the club. Certainly not China politically. You know, it's coming from a very, very different history and a very, very different background. So when you see these huge imbalances build up, and you know, the particularly large imbalance I'm talking about is the West, I would say America's trade balance, but it might just as well be the UK's trade balance with China, you know, which is consistently very, very negative. You know that the Chinese, when they're holding all these treasury bonds, all these gilts, they're not on our side in the same way that the French and the Germans and the Japanese were in the late 1970s. And I think that's probably the single biggest difference.
That's really great insight. I mean, what is you obviously mentioned that you feel like we're still in that kind of bull market phase. What is your long-term outlook for gold? How do you see it playing out over the next kind of 5, 10, 15 years?
Well, I'll tell you what, can we go back to the slides again? And let's roll on to the next slide, and I'll just give you an idea of how I sort of worked up my forecasts. And this shows the US total monetary base. And the grey line at the bottom is what actually happened until 2007. And then it's what would have happened from 2007 onwards had there been no quantitative easing. And then you have the light green line above that, and that's what actually happens. And then what was supposed to happen, if I come down here, with tapering, and it was supposed to do that and then sort of start going up again. And then I don't even remember, 2019, there was stress in the repo market. And suddenly the Fed said, actually, we're going to stop this tapering game. And so then what we were expecting to happen was this dark green line. And then that was my forecast. It was going to stay flat and then it was going to go up. And then this is with COVID. What actually happened was that huge reinflation. And this is where we are at the moment. So, one of my questions is, where is this going to go? So, now, the total US monetary base, which I think I said before, I regard as that's currency that is in circulation, currency that could be in circulation. And that has a very, very strong correlation historically with the gold price. Yeah. And probably the way to argue that is to say, look, US gold reserves in ounces or tons have actually been pretty flat since the 1970s, 8,134 tons in Fort Knox, or in the Federal Reserve of New York, probably Fort Knox. And so that hasn't moved. So that's why you set up the sort of assuming that you assume that the dollar is the anchor of the Western world's currencies. Yeah. Then you set up a relationship between the gold price and the total US monetary base. So as the US monetary base, as the more dollars that either are in circulation or could be in circulation goes up, you expect the gold price to go up to reflect that. Yeah. And that's what the next slide is, if I can. That shows the actual correlation there, monetary base along the bottom, gold price up the side, and that is very statistically, it's over to 0.9, so 90% if you want to express it like that. Yeah. It is definitely a statistically significant correlation. So the question is, where is the monetary base going to go to, and what does that mean for the gold price? If I go to the next slide, you can actually see that is the gold price in grey. Yeah. The monetary base in dark green starts at the bottom, and then the light green line is the interesting one, because that's what you would have predicted the gold price to have been in that year, based purely on the correlation as you would have perceived it at the time. And you can see that it's a pretty decent correlation. Yeah. I mean, it's a pretty good predictor. Now, the gold price goes over that green line sometimes, and it goes under it at other times, and you can measure that. And if we measure that and then say, right, what's the level of divergence? That's this slide here. And you're seeing, so you can see in 1980, for example, the divergence peaked up to over 1.6. There's quite an interesting thing here. If you look back to the 1970s, you see 1980, you see a peak, and then in the mid-70s, you see a peak. And quite often when we're doing these, because I do these correlations and this divergence from not only the monetary base, but also currency in circulation, also the level of the CPI, not CPI inflation, but the actual level of the C. And you quite often see this three-peak sort of pattern. So you've got one in the mid-70s, you've got that one in 1980. And then really it is, how do you want to interpret the rest of them? Yeah. We've definitely got a peak there in about 2007. But then actually it tends to shallow out. And what you see is at the very end, you see that actually the gold price, if you go right off to the right-hand side, you see actually the gold price is slightly below where you would expect it to be. So actually, if you take that to be a measure of speculative pressure, actually there isn't very much. You're saying, well, the gold price is roughly where it should be at the moment. Now, if I go to the next slide, that's exactly the same analysis, but this is with currency in circulation. You're looking at the divergence. You can see the three peaks better there. You can also see, if you look to the right-hand side, that the gold price is roughly where it should be. It's actually a little bit cheap. But the question is, where is the analog? And what I've tried to suggest is possibly the analog is you go back, you follow that big arrow there, and maybe the analog is in the 1970s where that arrow goes to. So we've been over one peak, and we've got another one coming sort of in front of us. So, there are lots of techniques that I've used here, and I've tried to bring them all together in this. And what you can see, if we get that speculative pressure, if we get the same sort of thing happening in, let's say, 2003, 2004, as we got in 1980, that's what I call cyclically adjusted. So I've got an average for all the cyclically adjusted things. Now, you see that big peak there. If that's the case, then the gold price we expect to go up to $3,000 an ounce. And I don't think it's a coincidence that's roughly the same 3,000 we talked about when we talked about real interest rates. But then we may not get those. Maybe the market will say, well, actually, the gold price is roughly where it should be, and, it was a bit silly in 1980, and so we're not going to repeat it all over again. In that case, you're sort of slightly looking at those three lines in the middle, which are sort of sloping upwards. And what you'd see is 2024, the gold price is a bit cheap. It should come up another $100, maybe $200, and then you're on this broad sort of, slow but noticeable sort of inflationary path, if you like. Yeah. And then if you have, and those are sort of what I call the non-cyclically adjusted. So you're either sort of going from cyclically adjusted high to low, or you're going from low to high. And just, for the purposes of our forecasts, we've taken basically the bottom of all of those and say, so I think we're quite conservative. I'd be surprised if the gold price in nominal terms went below the sort of things we're talking about. So really what we're looking at is we're looking, when gold hit almost $2,000 an ounce in 2012, an awful lot of people looked at it and said, a bit expensive. But the point is 10 years later, with gold at $2,000-ish an ounce, it's probably actually roughly where it ought to be. And then what we're saying is, so I think what we're saying to some extent is what used to be the ceiling has now become something that looks a bit like a floor. And we should have, a reasonable sort of uplift from these sort of points. And I think one of the other things just worth pointing out is we should have an uplift, but we also should have it with probably a lot less volatility than you might have. Now, of course, it depends, how you want to position yourself. Do you like volatility or don't you like volatility? But, this could be an island, an island of safety and security, which of course is precisely what gold ought to be going forward, for your wealth. Compared to the slings and arrows of outrageous fortune that you may be suffering in all sorts of other instruments.
Yeah, I mean, you just mentioned that $2,000 level there. How important is that as a level? Because you mentioned it hit it, I think, during COVID. It hit it again during Russia's invasion of Ukraine, and every time it's kind of come back down again. Do you see that psychological level once we kind of break through there meaningfully that could be bullish towards your case?
I mean,
or do you not pay attention to those?
The way I do my analysis, 2,000 is a random number. If I did it in base 12 or hexadecimal or something, it wouldn't be 2,000. It wouldn't have that psychological effect. But we know that those sort of levels do have a psychological effect. So, but I think the more times we test it, the more times we go through it, the longer it stays above it, the more likely it is that people will accept it as they won't see it as a barrier. And because we've been through it now, 2 or 3 times, and the last time for a reasonably extended period of time, I think the more that happens, the more it becomes a floor and the less it becomes a ceiling. So it plays a part at the margins, if you like, I think.
And that brings us nicely to the end there. So thank you very much for joining us today.
Pleasure, Tom.
And don't forget to like, comment and subscribe at home, and join us next time.